Welcome to Indianomics. In the past several months, indeed years, the global economy has given us jitters, either because central banks were hiking rates or because they were not hiking rates. So where is the global economy headed? 9 months back, it looked like all gloom and doom, a recession in major economies and probably devaluation by China. Suddenly the global economy seems to be in ship shape. Are old problems behind us? Today we are going to get you a 360-degree perspective of the global economy, the emerging market economy and the Indian economy from two of the brightest minds in JPMorgan and actually I would dare say in the economic community. I have with me Luis Aganes, the Chief Economist at JPMorgan, and Jahangir Aziz, the Chief Economist Emerging Markets again at JPMorgan. Thank you very much, both of you, for joining us. Luis, let me start with you. Like I said, we saw this debilitating picture of the global economy just as recently as December last, and the fears of devaluation in China. Are things really back in place, or can we yet again see recessionary trends because there are still negative yields?
What we are seeing this year is some sort of inflection point in which these dynamics that you are describing, which actually were prevalent for over 3 years, of constant growth disappointments, constant deceleration, and forcing us to keep downgrading growth projections across EM, all of a sudden stopped some months ago. We stopped downgrading our own growth projections. Why? Because the data started to validate whatever we had on paper, which was good news. And actually, over the past month or so, we in some countries started to increase our growth projections, which is something we had not done at least in 3 years. So I think that the message from that is that we're seeing a stability, some improvement at the margin, but this is of course after 3 years of deceleration. So it is not that we are expecting a boom in the quarters and years ahead, but we can at least say that the worst is behind, and I think that markets take comfort from that. So the fact that the worst is behind, and maybe this is then a time to start to get back into emerging markets, and this is why probably we're seeing more inflows coming back in.
Okay. Well, to emerging markets, let me take it from there to the Chief Economist on emerging markets. Jahangir, clearly the emerging market inflection point started when crude bottomed out, commodities bottomed out, restocking of steel and iron ore began probably in Jan or Feb. Now, has it already played out, or do we have to see much more improvement in commodities than we have factored in?
Look, I mean, just to follow up on what Luis was saying, that look, on one hand, we stabilized our growth forecast. There wasn't this relentless downgrading. But more importantly, we are actually come to a point where the negative surprises on the developed market growth, which was, we were putting out a developed market growth number and it was always coming below that. I think we have also adjusted to that by actually trimming down our developed market trend growth. So if you look at our 2-3 year growth, and this is not just for JPMorgan, for everybody else, we are looking at the US no longer at 2% but 1.5%. We are looking at Europe at 1% and Japan at 0.5%. Now what that does is that, and this is where Luis and I have been, we've been working on this for quite some time, is that it actually changes the dynamics between emerging market growth and developed market growth. So if you look at over the last 20 years, from early 2000 to 2015, you have one phase in which emerging market growth minus developed market growth. So emerging market, developed market growth differential went in favor of emerging markets. And what you saw as a result of that every asset class, emerging market asset, continued to outperform. FX, equity, rates, you just name it. Then from around 2010, which is what Luis was referring to, you saw that growth differential continuing to go against emerging markets at every asset class. Doesn't really matter what asset class.
Okay.
You are underperforming.
Yeah. My point is now we have seen commodity improvement and therefore you all are correctly factoring in growth. But now are we overstating the case?
No, we are not overstating. So if you look at our 2017 and 18 actual growth forecast in emerging markets, except for I would say Brazil and Russia, almost all our growth forecasts are just either lower or just about the same level of 2015. What has happened is the growth differential between emerging markets and developed markets. That's gone widening, and that widening is going to steepen and continue to happen throughout this 2-3 year projection period. So it isn't that we have gone and said, you know, India's going to grow at 10% or China at 10% or Brazil at 5%, etc. We are just seeing that the growth differential, so there is a lot of we're talking about relative underperformance and overperformance. We're not even saying that, you know, if the absolute returns are going to go from 5 to 10%.
No, I take your point actually, and Louis explained that earlier today as well. But Louis, this negative interest rates, should we worry that it is a sign of recession, or is this a sign of some altogether different demand-supply dynamics, that there are simply more old people and simply more pension funds and simply more central banks worried about banks and forcing them to buy sovereign paper? So how should we read negative yields?
Negative yields, I think, are the result of a number of dynamics, and I can bring up probably two main ones. You know, one is the fact that global growth, I mean, we have come out of the deep recession caused by the financial crisis in 2008, 2009. The recovery since then has been quite shallow. So there is insufficient growth, sources of growth in the world these days, and this applies both for emerging markets and for developed markets. Central banks have provided let's say the biggest policy response and the biggest support for growth, and to the extent that they reached the zero level, they decided to pierce it, which is unprecedented. You know, we have never seen policy, central bank policy reach, you know, this kind of expansionism. Asset purchases plus negative rates. This is an experiment, and we should think it as such. We don't know so far. It's probably avoided recession, so I would not put recession in the radar of concerns at this moment still, but it certainly has underwhelmed in terms of reigniting growth in a way in which we would all like to see. And that is why, and you saw that a little bit in the G20 meeting recently, there's a bit more of an active debate, even though policymakers are not reacting yet, as to whether monetary policy has exhausted itself, and now we should go back to think about fiscal policy, you know. Now, the problem with fiscal policy is that many parts of the world are still trying to reduce government balance sheets, are still trying to reduce deficits, you know, peripheral Europe, emerging markets, etc. Not everyone is has the capacity to do expansionary fiscal policy. So, you know, we're in this debate that I think is going to take some time to sort out. I don't think that the negative rates that we're seeing right now is going to disappear anytime soon, and if anything, you can think about the central banks in Europe, Japan, kind of digging themselves in a hole that is going to be very hard to come out of, to be honest.
Basically, what we are reaching is a situation where the central banks have run out of tools, and the fiscal side is not prepared with any fresh tools. No surprise, economics is a dismal science. But, you know...
I mean, there's still one tool left, right? Which is what we've been calling helicopter drop in money, right?
Okay, no, let's not get into that terrain. You know, I still want to drill it down more to India now. If this is the situation that you're looking at, that negative interest rates and possible helicopter money, which means that growth has not picked up globally. It's below past millennial, century growth rates for developed markets and emerging markets. Therefore, you know, what happens to the India piece, Jahangir? Are we being too ambitious by looking at 7.5% or even 8% growth? Should we moderate expectations? It is possible for an economy to grow only this much in a world that is not picking up.
First of all, you know, let's forget about the levels of growth. Let's talk about, you know, can growth rate move up? And let's talk about, you know, what is it that allowed growth in the last 2 years. One of the big factors that drove growth positively in the last 2 years was this massive positive terms of trade shock that came from this huge decline in commodity price. Now that's gone. So you need to look forward to what is going to replace that. So we have a bit coming out from monsoon. Government spending, you know, it's probably going to struggle given where the fiscal deficit is. So you're not really going to get anything out for public investment itself. So you really have to go back and look at private investment. And that's where been the question, not now, but for the last 4 or 5 years, that private investment has continued to languish and slow, and has come to a point where it's basically, unless that moves up, it is very hard to see growth moving up. I'm not even going where the level should be. And the question is
but
why...
we are still at 70% and under 70% capacity utilization.
That's exactly the point. So the point is that what is the reason why private sector is not investing? And I would say that apart from the various supply side impediments that the government is addressing through reforms, etc., I think the bigger thing is that, and it's a global phenomenon, is that there is no visibility of sustained demand, which goes back to the growth slowdown story. If there is no demand, as a private sector, why would I expand capacity?
Okay. I think we could end up in disruptive policies if we changed 8%.
I don't think, as Jahangir put it, the focus should not be in obsessing about targeting a high growth of rate of growth, but rather, how to get there. The how to get there is there's got to be a reignition of private sector investment. There is a lopsided growth dynamics in India right now, which is excessively reliant on consumption, which is, the product of this, positive transfer trade shock that is now exhausting itself. There is an attempt by this administration of trying to, narrow the fiscal deficit, which means that fiscal policy will not be providing the same support to growth that it has up until now as well. So what is going to replace that? Global trade is weak, so exports, maybe they have some room to recover, but it's difficult to imagine that being the source of growth going forward. It's got to be private investment, and for that you need more reforms to make private investment more viable, more attractive, more appealing, and for the private sector to feel that there is some money-making opportunities to be pursued given the reforms.
Let me squeeze one question in then. We will be in a budget exercise in the next 2 or 3 months. Will it make sense, therefore, to increase the fiscal deficit, going by the lingo of economists globally? Will it be suffered if it happened in India?
Well, I think at the starting point in India, I don't think that is a wise thing, because the fiscal deficit is already quite large, and yes, because of high nominal growth, the debt to GDP, public debt to GDP has been shrinking, which is good news, and this is what in a way is anchoring the credit ratings of India as a sovereign. However, let's not get overly excited about that. That doesn't mean that the fiscal space is ample. So, there is a debate to be had about, what pace you want to reduce the fiscal deficit. I don't think that the debate should be, let's expand it.
That's very useful lessons as we embark upon our budget exercise in the next 2 or 3 months. The plain lesson is, let's not get over-ambitious on growth. But while that is the economic piece, the banking and the financial sector has been considerably unshackled in the past 24 months. We will check out with Kalpana Morparia, a 4-decade veteran of the banking space, in a minute now, as to whether that will provide a kicker for growth. We are back in a minute.